what you're going to see here is that the SPY didn't really matter that much. If you wanted to wait a couple of extra days, no problem. In fact, in some cases, if you waited till 14 days, it didn't hurt you at all. But in Apple and Meta, it did make a difference. And in IWM, it did make a difference. So, well, mostly in Apple and Meta, but more so than the indices. But bottom line is that if you took 7 years worth of data and you looked at extending the time period for adjusting positions or anything like that, and you considered it for Apple and Meta, it didn't help you at all. In fact, it hurt you a lot, especially in low volatility. In the SPY and IWM, it didn't matter as much. There were times it was even better, but it's probably a pretty rare occurrence.
Yes.
Well, let's say we sold 20 delta strangles, 20 delta call, 20 delta put, 45 days. We examined 3 management techniques: keeping the trades on through expiration, closing them at 21 days, and closing them at 14 days. We filtered our results to contrast the overall results for those trades placed when IVR was below 30, as opposed to all times. Next slide. Okay, this is the one where it's kind of a little bit indifferent. First thing you notice is when you look at the win rates, nothing really changes much. 21 DT, any IVR, 78%. Nice. 14 day DT, any IVR, 75% wins. Expiration, 76. Not enough of a difference there. In low IVR, the numbers drop dramatically. Okay, so that's a risk. And also, you can see in 21 days low IVR, you didn't do very good in the SPYs. It just wasn't good. If you go to the next one, Beth,
and that's and if you notice when volatility is low in the SPYs, we typically find ourselves a lot more in individual stocks. When individual stocks are low, you find yourself a lot more in the SPYs.
Yeah, next one, please. So this one is IWM, and IWM, what we found is that when you do the win rates were all about the same, but the average daily P&L when you went to low IVR, which we have now, and you lowered the time frame, you didn't do very good. You didn't do very good at all. It got a little ugly. In fact, your CVAR went up, and your daily P&L was a net loser. This is selling strangles in low IVR. Okay, and trying to extend duration and do everything else. What's interesting here is if we go to the next slide, you start to look at the equities and you look at Apple. Apple, on the other hand, it's pronounced. So any IVR, Apple came right at around the expected rate, 68, 68, 70, whatever. And your P&Ls were positive if you managed to 21 days. If you went down to 14 days, you didn't do very good at all. If you went to expiration, you didn't do good. And if you went into low IVR and did the same thing, it was a disaster. So Apple's the first example. Now, Apple had some pretty good outlier moves and a lot of stuff happening there. So we can't discount all the stuff that happened in Apple over time. But when you look at Apple, and just think about this for a second, the only way really to make money in Apple was selling strangles in high IVR and taking them off at 21 DT. There was no other scenario.
Yeah, talk about mechanics being paramount.
Yeah, that's all mechanics. This is the same strategy. And some of them have major losses. $7, $6.50, 78 cents, or you make nothing. The only winner in there, which is not good in the case of Apple, 74 cents. Let's go to the next slide. So Meta, a little bit different. Meta, on the other hand, was treated customers better for the last 7 years. And in Meta, if you waited a little bit longer, you didn't have as much problem. Now, you see, we don't know like what one stock's going to do versus another stock. We don't know which one's going to be good or bad. Like we don't know, the real takeaway from this is that if you kind of follow the standard mechanics, 21 DT, any IVR, or obviously high IVR is the best,
of course,
but you're going to end up with the best results here. And if you wait longer and you had low IVR, the results, they tail off in basically everything that we do. It's
Which
just,
you would expect. You would expect it.
You would expect that keeping things simple and keeping things in the vein of high IVR works better. Let's go to the last slide.
Takeaways.
So it can be hard to turn a profit selling premium when volatility is low. Something we talk about. That's why when Chris Vecchio was just on and he was looking at gold, I'm like, I don't know what I can do in there.
Unless you want to be directional, the debit spread one way or the other. If you're bullish like Chris was, debit spread.
Yeah, I don't know what else you can do. Like unless your timing is perfect and you're doing debit or credit, whatever, and your timing's perfect. But other than that, and your directional timing's perfect. Not my thing. So it can be really hard to sell premium when volatility is low, but adjusting our mechanics can help. In the ETFs considered, letting the trades run to 14 days in low IVR increased daily P&L compared to 21 days without taking on a high CVAR. That's just your outlier risk. So there was some instances where you could hold it for a few extra days. Got away with it in the ETFs. In the equities, the CVAR, that's their tail risk, for management at 14 days was almost as high as holding through expiration without improvements to P&L compared to 21 days, regardless of IVR. There were no situations in the equities when it paid to hold longer in high or low IVR. And tailoring our mechanics to the underlying may be a key step to adopting new volatility environments. We're in a low volatility environment right now. We have to be very smart about what we do, but you don't want to try to get cute. And, occasionally, can you get away with holding the trade a little bit longer? Sure. But managing early, staying small, managing early, putting on lots of trades, still the best policy.
Key is remembering which ones to keep on. Just kidding. We're going to take a quick 90-second break and come back. We got more Tasty Live after this with, oh joy, Mr. Scott Sheridan next, Tasty Trade World Headquarters.